Good evening, ladies and gentlemen. Welcome to the 20th late Mr. K. Sivagananathan Memorial Oration. So let's start the proceedings with the APB anthem. Since 1998, a loyalty is with for our community. We are the members of either wealthy be they me. What's this for? Standing for all that we should be. What's going on back in governance? Let's make sure it's going right. Hey, we keep the first of we are the members of the APB. Standing on the wall in our society. And this is the future. We stand, we challenge circumstances. We shall contain by building on the strengths we uphold. With battles the things will be on. We are since 1988. We stand, we stand, So this is an annual event which is jointly organized by the Association of Professional Bankers and the Sivagananathan Trust in remembrance of Mr. Sivagananathan and his contribution to the banking industry. The theme of today's session is navigating Sri Lanka's economic challenges. And we have invited an expert in economics as our keynote speaker today, and two other eminent personalities in the banking industry as the panelists. So to start today's session, I would like to now invite Mr. K.B. Rajapaksa, the President of Association of Professional Bankers, to welcome the gathering.
Good evening, ladies and gentlemen. Eminent speaker, economist, keynote speaker, Mr. Deshal Dimel, and expert panelist, Mr. Sujiva Rajapaksa, Chairman of People's Bank and People's Leasing and Finance Company, and Mr. Sanath Manatunga, CEO of Commercial Bank, Mrs. Sivagananadan, and family members of late Mr. Sivagananathan, Council of Advisors, past presidents, council members, and distinguished guests. It's a great pleasure for me to welcome you here at the K. Sivagananathan Memorial Oration. Today we are holding this special memorial oration in commemoration of 20th remembrance of late Mr. K. Sivagananathan, who was a well-known veteran banker, recognized both locally and globally. He was a founder member and a past president of APB and was instrumental in setting up the APB and several important initiatives for the betterment of the banking industry. To recognize and appreciate the services rendered by him to the banking industry and banking profession, APB has conducted this oration annually in conjunction with the K. Sivagananathan Memorial Trust. It is common knowledge that we are currently facing a macroeconomic crisis of unprecedented proportions. In fact, it is not an overstatement to say that Sri Lanka is at a crucial turning point. We are not looking for economic revival in the wake of pandemic, but also have high aspirations to emerge as a strong economy despite a host of macroeconomic volatilities and challenges. The need of the hour is to put in place bold policy initiatives founded on rational thinking, as well as fast and effective implementation of pragmatic strategies that will help Sri Lanka reach its goals. In that context, many of us here must be wondering how Sri Lanka is going to navigate through these turbulent times to place itself on a sustainable pathway to progress and find opportunities for growth. This evening, we are gathered here to shed light on that very issue, and that is why I believe that this is going to be a fruitful intellectual exercise for all of us. We are fortunate to have a panel of high caliber speakers with us, including the eminent economist, Mr. Deshal Dimel, a well-known top business professional and chairman of People's Bank and People's Leasing and Finance Company, Mr. Sujiva Rajapaksa, and also senior chartered accountant, senior banker, CEO of Commercial Bank, Mr. Sanath Manatunga. Without a doubt, they will lead us to an insightful and stimulating session, which will give us much required guidance, hope, and inspiration. I hand over the forum to the moderator and senior vice president of APB, Mr. Jeremy Silla. Over to you, Jeremy. Thank you.
Good evening, everybody. First of all, I'll invite Anjali to introduce our guest speaker today, Mr. Deshal Dimel, and let Mr. Dimel have his presentation, and then we will start the panel discussion, which should be much more fruitful in taking up the questions and discussions with the panel. So over to you, Anjali, to introduce our speaker, and then we'll have Mr. Dimel to present his views on the current subject. Thank you.
Thank you, Jeremy. So now I'd like to introduce our keynote speaker. So our keynote speaker today is an economist who has experience across government, private sector, and academia. He's a research director at Verite Research, a Colombo-based think tank. He previously served as an advisor to the Ministry of Finance, prior to which he worked in the corporate sector as senior economist at the Haley's Group. So he was a commissioner at the Securities and Exchange Commission of Sri Lanka in year 2018 and 2019. Currently, he serves as an independent non-executive director on the boards of Sampath Bank, Janashakti Insurance, Capital Alliance Investments, and TNL Radio Network Private Limited. So he holds a bachelor's degree with honors in economics, philosophy, and political science from Oxford University, and an MSc in international political economy from London School of Economics and Political Science. Also, he has been recognized by the World Economic Forum as the Young Global Leader in year 2019. So, ladies and gentlemen, join me in welcoming Mr. Deshal Dimel.
Thank you very much for the kind words of introduction, and it's a real honor to be able to speak to you all this evening. So I thank the APB and the members of the Sivagananathan Trust for inviting me today. I was also fortunate to speak to the same forum 2 years ago in March 2020. Little did we know then that for the next 2 years we would be pretty much confined to computers and speaking to each other via remote meeting facilities. But it's good to be back in a physical environment after quite a long time. If I cast my mind back 2 years, I think the topic that I addressed that day was on de-risking the Sri Lankan economy. At the time, we didn't have the obvious turbulence that we have seen over the last 2 years, and we're still seeing today. And I was trying to outline some of the measures that we could take to prepare ourselves as an economy to be able to withstand some of the shocks that we have seen. So I think today what I'd like to do is to try to reflect on the current situation that we are facing right now. Particularly with regard to the depletion of foreign exchange reserves and the forex crisis and the manifestations of that, trying to understand where this has originated, and then thereby trying to derive some solutions as to how we can come out of this crisis in a stronger, more sustainable, and more resilient way in the future. But to start with, let's just go back a little bit to the past to try to understand some of the origins of this crisis, so that we can try to work out some of the next steps. One of the primary causes that, or one of the primary factors that has contributed to where we are today, actually came just before the pandemic. So, with the significant changes in fiscal policy that we saw at the latter part of 2019. There was a general sentiment amongst the global capital markets, the rating agencies in particular, that Sri Lanka's public finances are likely to get into a weaker position. Now, we must keep in mind that even prior to to 2019, Sri Lanka's public finances have been on a challenged circumstances. So, Sri Lanka's government revenue as a percentage of GDP has been low by global standards. In 2019, tax revenue was 11.6% of GDP, among the bottom 20% in the world even at that time. Debt to GDP was 86% of GDP, again high by global standards and amongst our regional and income peers. So public finances were already quite challenged. With those changes in tax policy in particular, there was a negative sentiment that came about, particularly amongst the rating agencies. So on the 16th of December 2019, Fitch revised Sri Lanka's credit outlook to negative, and they cited the changes in tax policies and concerns about overall fiscal outlook as a result of that. And I would think that was one of the first steps that that we faced. And subsequent to that, obviously, government revenue declined to around tax revenue declined to around 8% of GDP in 2020. Probably stayed at a similar level in 2021 based on current estimates that we have, and that leaves us around among the lowest 5 or 6 countries globally in terms of government revenue, and this has obviously contributed to further increases in budget deficits and public debt as well. So as I said, this was one of the first points at which the global market sentiment towards Sri Lanka shifted in a somewhat adverse manner. With the decline in with those policy changes, we also saw a decline in the overall tax base as well. So a couple of examples here on the right, you have the decline in individuals registered for APIT or for PAYE. With the abolition of PAYE and the conversion to APIT, there was a 42% decline in those registered for personal income taxes through these schemes. VAT as well, the threshold was increased from 12 million, tax-free threshold was increased from 12 million rupees per annum to 300 million rupees per annum, a 25-fold increase in that threshold. That also resulted in a significant number of companies that were previously paying VAT to move out of the VAT net. So overall, we saw effectively a 33% decline in total registered taxpayers in the economy. So that's a significant erosion in the tax base, and it does compound the challenges in terms of government raising revenue and being able to balance its overall fiscal position. So these were some of the concerns that started to emerge amongst global capital markets rating agencies in particular. And of course, the decline in revenue then contributed to rising budget deficits. So in 2020 and in 2021, we had budget deficits of over 10% of GDP, again, very high by global standards. Of course, we must keep in mind that the pandemic had implications both for the increase in budget deficit and for the decline in government revenue as well. But what we have seen in Sri Lanka was significantly higher than some of the deterioration that we saw in some of the other peer markets, again, considering Sri Lanka's starting position as well. So with these adverse developments on the public finance situation, we saw Sri Lanka's public debt, government debt, along with the debt incurred by state-owned enterprises, increasing from around 96% of GDP to around 120% of GDP estimated for 2021. So that's a very steep increase. And all of these factors have contributed to Sri Lanka's credit ratings being adversely marked down in the subsequent few quarters. This chart maps out what's happened with our rating. So you could see the first downgrade post-pandemic was in April 2020. So this highlights Fitch ratings for Sri Lanka. So we went to a level of B- from a level of B rating. Now, what happened there was that Sri Lanka at that point lost access to global capital markets. So we were previously, even with the adverse debt to GDP ratios, relatively weak government revenue capacity, Sri Lanka still was able to borrow from global capital markets, albeit at high rates. We were borrowing at in the primary issuances of over 7%, late 6%, and so on. But with the downgrades of the credit rating, we lost access to global capital markets. And then we had subsequent rating downgrades in 2020 November post-budget, and again 2021 December post-budget as well. So at a CC rating, we are pretty significantly locked out of capital markets, and that affects not just the sovereign; it also affects the rest of the economy as well. So even banks find it more difficult to be able to engage in trade finance with their counterparties, given the fact that all of the entities within the economy would be subject to the credit rating of the sovereign. So with the decline in our credit ratings, we still had large amounts of liabilities that needed to be met. The sovereign had large debt liabilities that is still need to meet going forward. This chart outlines the the debt service costs for the sovereign. So it indicates the dark blue lines indicate the capital, the principal repayments, and the green lines indicate the interest payments. So what we can see is from around 2019, Sri Lanka has had to, on an annual basis, have debt service payments of in the range of $4.5 to $5 billion per year. And you can see this is quite a sharp increase from where it was about 10 years ago. And one of the main reasons is that most of Sri Lanka's ISBs that we started investing in from 2007 have started to mature from around 2019. So we've been enjoying a period where we were able to raise money in capital markets, and the maturities have only started now. So the overall external account of Sri Lanka has changed very materially from around 2019. So you couple the situation where we have $4.5 to $5 billion of repayments per year, combine that with a situation where we lose access to global capital markets, that puts Sri Lanka in a fairly difficult situation. Now, normally an emerging economy like Sri Lanka, that is a market borrowing player, what they would do is they would engage in global bond markets. When maturities come for repayment, they would raise fresh financing from the market, refinance the maturing capital portion, service the interest, and carry on that way. Much like how the sovereign in Sri Lanka manages treasury bonds on the rupee market. No, you don't try to prepay all the capital in one go. You keep refinancing, servicing the interest, and then carrying on. Typically, that is what a middle-income country would do with regard to global bond markets as well. You get into a difficult situation when you're not able to tap into global capital markets to refinance your debt. So then we don't have a lot of options, right? So Sri Lanka is typically a current account deficit country, which means we don't generate a surplus in terms of our trade in goods, remittances, trade in services, tourism, etc., to be able to meet our financial market obligations. So financial markets, we need to attract fresh inflows either through FDI or through borrowings. So when you're locked out of your key borrowing avenue, you don't have a lot of options to play with. So what Sri Lanka has been doing since we lost access to global capital markets has been servicing our maturing foreign liabilities using our reserves. And that has naturally led to a very significant depletion of reserves in a relatively short period of time. So this chart illustrates what has happened with reserves over a long period of time, from between 1950 and the present. The red line indicates gross official reserves in US dollar terms, and the blue line indicates what how much of imports per month those reserves cover. So if, for instance, if you import $1 billion per month and you have $2 billion of reserves, you have two months of import coverage from your general reserve position. Now, typically, a country would want to have a safety net of reserve coverage of at least 3 to 4 months of imports, right? So Sri Lanka now is in a situation where we are well below that level of import coverage, and therefore there is a significantly high level of risk, and some of the challenges that we are facing today are really associated with that situation. So what we can see today is our present reserves have about 2.5 weeks of import coverage. So under 1 month of import coverage, if we consider usable reserves, I'll talk about that in the next slide. And that's the lowest level that we have seen since around 1975. I think there was one dip you can see in the graph where it comes down to a similarly low level, the blue line. But it is pretty much unprecedented over the last 50 years in terms of the decline in reserve coverage that we have. And that is very much to do with the fact that we've been compelled to meet our debt obligations to our tapping into our reserves. So this is an illustration of where now, and this kind of captures the magnitude of the challenge that we face. So here again, the line graph on the left is an indication of our gross official reserves. So at end of February, the data was published earlier this week. Sri Lanka's gross official reserves were $2.3 billion US. Now, it's important to remember that $2.3 billion also includes a 10 billion yuan swap from the People's Bank of China. Now, that swap is denominated in Chinese yuan. It's not denominated in US dollars. It's equivalent to 1.58 billion US dollars. But we don't have clarity as to whether that can be used to settle US dollar denominated liabilities. The understanding is that it might not be usable in that way. So you can use it to for transactions on denominated in Chinese yuan, be it imports or for any other liabilities, any other invoices that are yuan denominated. But given the fact that we are unclear as to whether that can be usable for dollar payments or not, if we exclude that from our reserve calculation, our usable reserves at the end of February were down to around 734 million US dollars. And that includes about $98 million in gold, $123 million in SDR, and a small IMF reserve as well. So the cash reserves were around $500 million as at end of February. On the right is a data point that we see from that indicates the liabilities that Sri Lanka has to settle over the 12-month period between January and December 2022. The total there is a figure that we have seen in the media quite a bit, $6.9 billion for the full 12 months, of which in January we already settled around $800 million. There were some settlements in February as well. The data for that is not out yet. It should come out tomorrow. But what we can see is that there is still a large amount of liabilities to be settled with a relatively low level of reserve coverage that we have available to us at present. And that is really where the crux of the problem is. So, for instance, earlier this week, on the 7th of March, there was a ACU, Asian Clearing Union payment that fell due. It was reportedly around $914 million. And it looks like our reserve level probably wasn't sufficient to meet that. The Indian government, the Reserve Bank of India, was willing to defer that payment by a couple of months. So we get a bit of breathing space on that. But I think that really highlights the challenge that we face right now, given the significant divergence between available reserves and the liabilities that we need to meet. And this chart highlights how that has behaved historically as well. So in green you have the reserve figures, and in red you have the known liabilities over the 12 months in the future. So you can see that where we are right now, we have probably the highest divergence that we have seen, adverse divergence that we have seen in recent times. So how has this related to economic activity, to the functioning of business, to the functioning to the welfare of consumers? Now, given the fact where you have a lower level of reserves and also liabilities that need to be paid, the central bank has a choice of what we use those available reserves and whatever inflows we have, how we use that. So you have a choice between using your available reserves and your foreign exchange to settle your liabilities, or you can use it to provide for payments for imports and other outflows. In this situation, what we have seen is the reserves have been effectively channeled towards meeting our debt repayments on time, and that has reduced the level of foreign exchange that we have for general economic functioning. And that we have seen manifesting in the banking sector as well from around the second half of last year. The inflows into the banking system have generally been exceeded by the outflows. Typically, in that situation, a bank would go to the market and buy dollars in the forex market, but that window has narrowed as well with the limited availability of forex in the market, and effectively then banks have to start rationing their import customers as well. So gradually you see imports are turned away, are declined, because there's simply a lack of foreign exchange to be able to service this. And this problem is now getting increasingly acute, given what we are seeing right now with regard to the situation on foreign exchange reserves. So that's really the manifestation of that we have all seen. We've seen it in terms of the inability, the shortages of fuel to run our power stations, shortages of essential commodities such as cooking gas, a number of food-related commodities. So a lot of this really stems from the situation that we see on the in foreign exchange. So the other question that we need to then figure out is this a short-term issue that is largely due to the pandemic? Once the impacts of the pandemic are fully mitigated, will we be able to come out of this? Or is this a more structural, longer-term issue, which is beyond a liquidity crisis and more solvency crisis? And so a viewpoint taken, there's one school of thought that this is very much a short-term problem, that once the pandemic is over, once we see tourism coming back fully into full gear, once we see remittances returning in its full form, that we will be the foreign exchange gap will be met and will be narrowed. And until then, we simply need to have some short-term financing measures such as swaps, G2G transactions to be able to meet that temporary shortfall. I have a slightly different view. I think that the problems that we face are more structural and long-term in nature as opposed to short-term problems. Just two illustrations of that. So one is whether the question of whether a full recovery in tourism would be sufficient to solve Sri Lanka's debt-related problems. Now, generally, we hear a figure quoted that earnings from foreign exchange earnings from tourism amounts to around $4.5 billion per year. This figure comes from our best year in tourism, that was pre-Easter Sunday in 2018. We had $4.4 billion worth of tourism-related earnings estimated in that year. Now, the graph I showed you earlier indicated that you have about $4.5 billion to $5 billion worth of sovereign debt repayments each year. If you have $4.5 billion from tourism, story should be relatively okay, right? Now, the issue is that if you look back, even in 2018, we had $4.4 billion estimated earnings from tourism, but that year we still ran a current account deficit of 3.2% of GDP. Right. So, and even previous years when we had reasonably good levels of tourism, we still ran relatively large current account deficits. Now, for tourism to solve the problem, you need to be able to run at least a minimal current account deficit or a surplus that's able to then address your financial segment of the balance of payments. So, if you're still running deficits with tourism at its peak, you're probably not going to solve the problem. The other issue is, I think that there is probably an issue with the estimation itself. So if you look at this breakdown, this figure of 4.4 billion in terms of where that estimate comes from, if you look at the numbers in 2018, that figure is derived from three different estimates. The first is the arrivals figure, right? So you have 2.1 million arrivals on average in that year. That's an objectively verifiable figure. You can look at it from the immigration data. I think that's a reasonably fair estimate. The second component of that overall earnings estimate is a figure of 10.4 nights as the average stay per tourist. That also seems quite reasonable. If you look at the short stay business visitors, the 3 weeks tourist visitors on a balance, it would likely come to around 10 to 11 days on average. So even that 10.4 figure seems to be a reasonable defensible figure as contributing to that overall estimate. The third component is the more problematic one. The third component is the average daily spend estimate per tourist. Now, this is derived from an exit survey that's done at the airport by speaking to tourists who are leaving the country. And according to that, in 2019, we had the average daily spend was $181 per tourist per night. That to me seems a little bit exaggerated, right? So if you're looking at a couple, then the couple would be spending $360 per day for 10 days. Again, this would be defensible in a situation where where you're spending a lot on accommodation. So in a country like the Maldives, for instance, that kind of spend you could probably expect, or if everybody's staying in 5-star hotels. But if you look at the average stay in 5-star, the average tourist guest nights in 5-star hotels between 2012 and 2019, only 11% of total guest nights was in 5-star hotels. So it's a bit difficult to fathom a situation where the lower grade accommodation facilities will be able to command the kind of premium that can justify a $360 per night spent by a couple. So a family of 4 would have to spend over $600 per day, or more than 120,000 rupees, right, at that time. So to me, that seems problematic. And on this chart, you can see comparisons with some of our regional peers, countries like Indonesia, India, Vietnam, Nepal. Their daily spends are probably 2/3 of what we have in Sri Lanka. So you couple that with also the spending by Sri Lankans traveling overseas, the actual level of net earnings from tourism is nowhere near this 4.4 billion figure. So again, going back to our 2018 example, we had 4.4 billion estimated revenue from tourism, but from the outflows, there was 1.6 billion. So even with that 4.4 estimate, you're looking at a range of around 2.8 billion dollars on a net basis, right? So that's probably going to be less if we revise the daily spend estimate to a more reasonable number. So I think that expecting this problem to be fully solved once tourism comes back in its full capacity, I think that is probably a mistake, and we shouldn't expect that this sector alone can solve the problem completely. Not to be mistaken, it certainly helps. I think there's certainly a big positive impact from tourism, not just on the forex side, but on the overall economy in terms of employment. But to put all our eggs into one basket in terms of thinking that this sector alone can solve the debt problem is probably mistaken. The second point that I wanted to raise was it doesn't look like the pandemic was the key driver of reserve depletion in Sri Lanka. So here there's a comparison of the change in gross official reserves amongst a number of peer economies. So we have India, Bangladesh, Maldives, Pakistan, Malaysia, Thailand, Indonesia, Philippines, looking at what happened to reserves in these countries between 2019 and 2021, the period of the pandemic. Now, many of these countries also rely quite a lot on sectors like tourism, right? So Thailand relies a lot on tourism, Philippines relies a lot on remittances, Malaysia relies on a bit of both. So what we can see is a substantial growth or a growth in many of these countries in terms of their. In Sri Lanka, we saw quite a sharp decline in reserves during this period. So again, in terms of I think one factor was the fact that global oil prices were extremely low, which supported the net importers in this region. Remittances actually grew for many countries during this period. So Philippines would have benefited from that. India, Pakistan benefited from that. And of course, remember the IMF also provided the SDR allocation in August 2021. That would have also bumped up these figures quite a bit. So really my point here is that Sri Lanka's problems stem from beyond factors related to the pandemic. It stems largely from what we spoke about earlier, the loss of access to global capital markets, the downgrade in our credit ratings, and then having to service our debt out of our reserves. That I see as the main factor that has caused this reserve depletion. And until we solve that, I don't see us being able to come out of the situation that we face right now. So what are the steps that we need to take in terms of coming out of this? What are the paths available to us in terms of solutions? So I would like to break this into three separate areas. The first is a scenario where a third party would come and bail Sri Lanka out. And I think early on there was expectation that countries like China, countries like India might come in with large financial support to be able to tide Sri Lanka through the challenges that we face, particularly during the pandemic, and until we are able to recover from that. Now, there's a couple of reasons why I would put a relatively low probability of this third-party bailout scenario materializing. The first is if you look at the actual assistance that Sri Lanka has received from countries like India and China. Now, China was the first country to provide large amounts of support in early 2020. In April 2020, the China Development Bank extended a $1 billion loan facility that was drawn down in two tranches in April 20 and then April 21. And then subsequently, they upsized that to a further $300 million equivalent. But from 2021, Chinese support has not been in US dollars. It has been in RMB, in yuan. So the the $1.5 billion equivalent swap that you referred to earlier, that was a yuan denominated swap. The upsizing of the CDB loan that was drawn down in October 2021, $300 million equivalent in yuan. The way I read that is that the Chinese are saying, look, we want to help you guys out. We want to make sure that your economy is able to tide through this, but we will give you support so that you are able to buy China imports from China or any other services from China that is denominated in yuan. I read it as them saying, look, we don't want to give you dollars to pay back your creditors in America and in Europe and wherever else. India appears to be a little bit similar, right? If you look at the recent support extended by India in terms of the credit lines, the credit lines are effectively $1.5 billion that enables us to buy certain products from India, whether that's fuel, pharmaceuticals, food-related products. Again, that doesn't come into reserves. It doesn't enable us to use that money to settle our creditors. They did provide $400 million as a swap from the RBI. That's for effectively a 6-month period, not in the kind of volume that's again able to address our debt repayments. So the way I see this is that our key bilateral partners are willing to support Sri Lanka. They understand that we are facing a challenging situation. They want to make sure that the economy has the key imports that it requires to survive, but they don't want to give us money. They don't want to give us public funds that would go off to pay private creditors. I think that's a justifiable position that these guys are taking as well, right? So that's why I don't put a lot of expectation on a third-party bailout being able to solve Sri Lanka's problems on a sustained basis. Also keep in mind that it's not just 2022 that we have this challenge. We have this going forward as well with the recurring repayments that need to be made. The second scenario is what you would call a disorderly default. Now, this is where the sovereign would either miss a coupon payment or a capital payment of a external loan that falls due, and it does so without a prior negotiation or engagement with the creditors. And it can be a very messy situation. It has very long-term ramifications in terms of a country's creditworthiness, in terms of its reputation in global markets, and it can take a very long time to emerge from such a situation. And this is a kind of situation that I think no country would really want to go through. It's effectively what happened to Lebanon last in 2020. And we see the negative ramifications of that. I would again continue to put a relatively low probability of this happening, because again, I think that this is something that is in nobody's interest for this to happen. So the third scenario, which I would think is the most pragmatic option that Sri Lanka has in today's context, is to enter into a negotiation with our creditors to restructure our debts in a preemptive manner, right? So here, what would happen is you would appoint restructuring advisors who would engage with your range of creditors. That includes your private bondholders, your multilateral creditors, your bilateral creditors. The whole range of creditors has to be dealt with, and then you come to an agreement that you would delay your capital payments by a certain period of time. If required, you may need to take the creditors may need to take some kind of haircut, or any different ways of restructuring your debt. What that does is it buys you some time, buys you a period of time to set in place the economic reforms that you need to restore your credit ratings. So if this is done properly, what you can do is you say you delay your capital payments by 2 years for all of your creditors. That gives you 2 years to get your fiscal house back in order, to restore your government revenue structures, to put greater controls over government expenditure, bring your budget deficit under control, and then gradually be able to get your credit ratings up from a CC level back up to a level of B minus. That will then enable you to re-engage with global capital markets and then get back on track into a path of being able to refinance your debt and on an orderly managed process be able to meet your liabilities. So that's the idea of a restructuring. Now, it's a complicated process, and it's certainly not a pain-free process. So I've said in brackets here, orderly default, because even a debt restructuring is a default in payment. So it is, as soon as a country enters into a debt restructuring, your credit rating goes from a CC level, a notch below what is called restricted default. And that makes it even more challenging in terms of being able to meet your trade financing requirements, in terms of being able to engage with global markets in general. So that is one of the reasons why typically a country would go into a debt restructuring supported by an IMF program. So when you have an IMF program that is also underpinning a restructuring, that IMF program it has several functions. The first is that it can unlock certain forms of bridge financing. So when, say, a country like Japan or even China and India see that you are engaging with the IMF on a program of macroeconomic reform, that then gives them confidence that, look, we should be able to lend money to this country again with a better chance of getting settled in the future. So it unlocks sources of financing that you would need in a situation where your credit rating is in a restricted default mode. So that is one reason why the IMF is important. A second reason why an IMF program is important in this situation is that the IMF is the institution globally that has the credibility to be able to provide a debt sustainability analysis that is accepted both by a sovereign and by creditors. Now, the sovereign will otherwise, if there is no kind of neutral entity, the sovereign will say, look, we need to have a 5-year delay in payments, we need to have 50% haircuts, otherwise we can't, we can't make our debt sustainable. The creditors, on the other hand, will say that, look, you guys just need 6 months, we don't want to give you more than that, and then you can come to an impasse. So you need a neutral entity that's able to say that, look, this is the debt sustainability analysis that we have for this country. Based on this is what we would recommend in terms of duration of moratorium, magnitude of haircuts, if any, and so on, right? So for those reasons, I would say that a debt restructuring that is underpinned by an IMF program is probably the most pragmatic approach that Sri Lanka could go through in this situation. It's quite late in the day. Ideally, this should have been done at a point where our reserves were a little bit more stable, so that then you have a little bit more kind of runway to go through a challenging restructuring process. But still, it can be done. And I would still think that this is the best option that we have right now. But just want to reiterate that restructuring is not a painless process. It has ramifications for the banking sector as well. Any debt restructuring means that there would be additional provisions that need to be taken on your sovereign, your exposure to foreign currency sovereign securities. So there is pain around this, but it's again a choice that we have to make, right? It's whether we want to choose a path that gives us a chance of restoring our credit ratings, regaining access to markets, or continuing to muddle through like what we're doing right now, but facing severe limitations and restrictions on forex availability that hurts the economy, it hurts businesses, hurts consumers, creates a lot of uncertainty, hurts future investment as well. So I think that's the choice that we have in our ahead of us right now, and that's really what we need to consider. My penultimate slide is a quick look at some of the highlights from the IMF's recent Article 4 consultation, the press release that came out of that. I find this important and interesting because it spells out some of the items that are likely to be components of an IMF program if Sri Lanka chooses to enter into one. The first point, though, is that the press release post Article 4 does confirm that IMF considers Sri Lanka's debt to be unsustainable. The meaning of that is Sri Lanka is not able to enter into an IMF program without a commitment to restructuring its debt. So IMF will only lend to countries that they consider debt to be sustainable. So any country that has unsustainable debt, according to the analysis, would have to enter into a restructuring process in order to be able to qualify for a program. Now, in terms of the recommendations, the section on the right, so I think this is important because it hints what kind of elements of IMF program is likely to entail. First point here is higher income tax and VAT rates. I read from that an expectation that Sri Lanka would need to shift back to a taxation structure more similar to what we saw pre-December 2019 in terms of VAT rates, income tax rates, and so on. The second point is on minimization of tax exemptions. This is probably referring to some of the large tax holidays that we've seen through programs such as SDP. I would think this will be probably quite contentious from a negotiating perspective. I think the government has been quite keen on tax holidays for Port City in particular and some of the SDP projects as well. So this might be a contentious issue in the negotiations. IMF is likely to insist that any tax concessions or tax holidays should be based on the capital allowances regime that is introduced in the Inland Revenue Act of 2017. That's my sense is that that is probably what they would expect in this second point. Expenditure rationalization and budget execution, again, fairly standard measures there. Another point is reform of state-owned enterprises. So here it's important because there is no reference to divestment or to privatization, which is generally what is thought of when you think of the IMF and SOEs. But again, similar to the 2016-19 program, there was no insistence on divestment of state entities, but on development of business plans for those entities that define a path to profitability. So again, I would think a similar expectation would be is being spelled out here as well. Cost recovery, energy pricing. So that is fuel and electricity to be priced at reflecting the cost. So expecting market-based pricing of both of those areas, which again adds costs to the economy, but again is probably a reform that Sri Lanka needs to do at some point. And then monetary policy. So tighter policy whilst phasing out direct financing of the fiscal deficit. Again, this has already been done, right? So from September, the central bank has stopped direct financing of the budget deficit. Common parlance we refer to as money printing. That has effectively been curtailed since Q4 2021, and central bank has already raised interest rates by 200 basis points, most recently by 100 basis points last week. So already we are seeing measures on the monetary tightening, exchange rate as well. Here also they say a return to market determined flexible exchange rate. Central bank has already taken the correct measures, in my opinion, in terms of coming down to this path as well. Structural reforms are looking largely at labor force participation measures, women's increasing female labor force participation, reducing youth unemployment. Again, not contentious stuff, effectively reforms that Sri Lanka needs to be doing regardless. And then phasing out of import restrictions gradually and unwinding of capital flow limitations as well. So a lot of what we can see is some of these already are being undertaken. So Sri Lanka is starting to take some of the tough measures with regard to tightening of monetary policy, some fiscal measures as well. We saw the tax changes on some of the imports, exchange rate. Again, so some of the most challenging and costly measures are already being put in place. But we are at the moment not reaping the benefits of having an IMF program whilst doing this, right? So if we were to enter into an IMF program underpinned by these reforms, we can then benefit by unlocking some of the sources of bridge financing and so on as well. That can support our reserves in the short term whilst we go through this challenging period. Someone might ask, okay, why can't we do these reforms ourselves? Why do you need the IMF to come and tell you what to do? So the IMF's role, I would say, is twofold. The first is, of course, in whatever money that they provide, but I think that is a relatively small role compared to the role that they provide in instilling confidence in a macroeconomic reform program that a country undertakes. And that is really where the value comes in. So when an external creditor sees that this country is involved in an IMF program, they get a sense that, look, there is a clear path that these guys are on. There is oversight from an independent body to make sure that there is a progress in terms of the reforms that are being undertaken. The risk of rollback decreases significantly when a country is part of a program. So just to illustrate why that is necessary for a country like Sri Lanka, Fiscal Management Responsibility Act, it was I think legislated in 2003. What this chart shows is how, so the FMRA basically sets certain rules in terms of your limits on public debt, limits on your budget deficit, limits on public guarantees. And it says that by a certain period of time, your public debt should be 60% of GDP, 50% of GDP, etc. What we have seen over the years is that whenever Sri Lanka comes close to the date and we are not meeting the target, we just raise the bar and we shift our goalposts. So this is a piece of legislation like the FMRA is supposed to be our own mechanism of instilling commitment, instilling confidence. But when our own mechanisms don't work, that's when you need to have external anchors of that confidence, or external anchors of that credibility to make us more credible to our global partners. So that is why institutions like the IMF have a lot of value in countries like Sri Lanka, because globally there is often capital markets don't take sufficient confidence from measures that we take on our own. So for those reasons, I would say that in terms of Sri Lanka's path forward, the best option that we have would be to enter into an immediate process of negotiating with our creditors to restructure our debt, underpin that restructuring process with an IMF program that will then unlock some bridging finance that will enable us to replenish our reserves in the short term, and buy ourselves a couple of years, which will enable us then to set in place some of the fiscal reforms that we need to do to build up our credit ratings, and then eventually be able to regain access to global capital markets, and then get back on track in terms of managing our external liabilities and stabilizing our macroeconomy as we do so. Okay, let me end there and look forward to hearing the comments from the two panelists and then taking any questions that you might have as well. Thank you.
Thank you, Mr. Deshal Dimel, for that elaborative speech and for sharing your insights and also enlightening us on the reforms for a sustainable recovery. So at this time, I would also like to mention that we have made arrangements to broadcast this event live on YouTube and also via Zoom. Now let's move on to the panel discussion. So joining the panel, we have two eminent personalities in the banking industry, Mr. Sanath Manatunga and Mr. Sujiva Rajapaksa. Mr. Sujiva Rajapaksa is a managing partner of BDO Partners and currently serves as the chairman of People's Bank and chairman of People's Leasing and Finance PLC. He is also an independent non-executive director of Haycub, Dip Products and Haley's Agriculture Holding Limited. His expertise includes accounting and finance, banking, auditing standards and practices, government regulations related to financial disciplines and ethics, human resources management, and overall management practices and principles in both private and public sectors. And Mr. Sanath Manatunga is an executive non-independent director and the chief operating officer of Commercial Bank, and also a director of the bank's Maldivian subsidiary, Commercial Bank of Maldives Private Limited. He has over 32 years of experience in the bank, having held many corporate management and senior management positions. He has also served as a council member of the Association of Professional Bankers and a member of the SEMA Thought Leadership Committee. So let's move on to the panel discussion. So I would like to invite Mr. Sanath Manatunga and Mr. Sujiva Rajapaksa to the head table. So I would like to invite Mr. Jeremy De Silva, the Senior Vice President of APB, to conduct the panel discussion.
Navigating against economic challenges, you see, is a daunting task. And today, with our eminent panelists, we want to divert a little bit more than our economist, Mr. Vishal Dimel, said, something which will be more practical, sense which are really boiling for our bankers and some of the private sector firms that are being present here today. So I would start off with series of questions to the panelists, and we'll have a discussion over that. To start off is, as we see, even the IMF rule paper 4, one part was a risk, downgrading of risk. So I would like to pose this to Mr. Manatunga. Now, you've been in a private sector, large commercial bank, and with a diversified areas of operations and with a regional presence. Now, time to time, there have been risks evolving with economic challenges. Now, within the region, you would have seen different types of risks that have evolved. I mean, from your view, how has the organization or how can this risk be managed in your organization? And what are some of the takeaways that you can share with the forum here on management of this risk in such tidy economic situations that we are facing today?
Thank you, Jeremy. Good evening, everyone. Thank you for, I should thank APB for inviting me to this forum, but relatively difficult topic to discuss these days. So I think the question is how the risk management can be done and our experience, because we are operating in 3 geographies, Sri Lanka, Bangladesh, and Maldives. So firstly, I should say the basic way of managing risk is to reduce concentration. So if you take commercial bank, we went into Bangladesh in 2003, where Sri Lankan reserves had been 2.3 billion and Bangladesh had been 3 billion. Today, they are at 48 billion and we are 1 billion. So what made this difference is there are so many things happen, but if you see all 3 countries, there are commonalities. All are South Asian. We have similar political turmoils, problems from time to time over the last 20 years we are speaking of. There are dependent industries, but sizes are different. So one thing I took from Mr. Dimel's presentation also, to what extent we are having policy consistency. Now, FM, RX, our change in the goalpost when we are reaching a threshold is not a good way of managing risk. Right? Risk management thresholds are there to indicate something and take action. Those can be management action triggers. But if the goalpost and this policy consistency is not there, then we will definitely face problems. So to differentiate these 3 countries, I will give a good example. Maldives is having a very high concentration on tourism. So they have very consistent policies and supportive regimes, irrespective of the political changes in that country. There are 28% of direct GDP is from tourism, 60% of the foreign exchange earning is from tourism. They know they have to protect that. Then if you see how they revive the tourism post-pandemic, they had the plan, and with losses and with government support, they started hotels opening in August 2020 when we had the pandemic. So they wanted to give, there are customers who are hoteliers, they said, we want to give a indication to the tourists who are looking at the winter 2020, 2021, that the hotels are open. No tourist will book a hotel which is closed and not non-operational. So they took the risk. They bite the bullet. Even at that time, we didn't know how long this pandemic will, prolong, or even the vaccination programs were not there. But they had to survive on that. Then December 2020 had been around 50-60% of arrivals. Last December, nearly 100%. So that's how the policy consistency, and they protect the crown jewels. Then in Bangladesh, there are certain industries like garment. We started garment industry in Bangladesh, Sri Lanka. Now they are huge, but they have backward integration to textiles, to dyeing, washing, finished garments to exports. And they support. Now even while we speak, they have a protective interest rate regime for exporters, capped at L plus 3.5. So that's how they build their reserves over a period of 2 decades. Whether we had that consistency is the question we have to ask. So it's bad risk management, I would say. Then on the other hand, very small island nation like Maldives, they had their fair share of political turmoil, but if you see the tourism industry, number of hotels coming up, the ability to freely, deal in foreign currency like dollars. So those are supportive things that they keep to sustain these industries. If you see the tourism spend in Maldives, I think it was not there. It's much higher than Sri Lanka because they sell a room at 350 plus, and everything should be bought within the island. And so they manage their risk, and risk management is not only managing downside risks. Upside risk is the opportunity. So they manage opportunities well. So I think those are the learning points from the three countries we operate. And we are happy that we went to Bangladesh, which is contributing about 20% to the bottom line. See, a small contribution from Maldives, but we are happy that we have another, diversification of the risk from the sovereign country, which is good for our country also. So we also should think of supporting these corporates to go overseas, expand, even increase their footprint in overseas locations. Because in certain areas we are good at, doing our things like tea exports. We are good, IT. We can create hubs. So the support and the policy consistency and that the strategic vision should come. Thanks.
Thank you, Ms. Mandapur. Mr. Rajapaksa, now coming back to some of the concerns even the IMF raised was how the management practices or how they adopt in managing entities and things. Now, one daunting task is we have a lot of SMEs and microfinance type of industries in Sri Lanka. Now, in this challenging economic times, now these industries find it difficult to meet the requirements or how they could face up managing their financial matters or management techniques. So can you share some thoughts, Mr. Rajapaksa, with you being expertise in the accounting field, setting up standards and also being a moderator for entrepreneurs, how they could overcome, because I think the market opportunities, if you talk of the swap, everybody talks of the strength and weakness, but the opportunities that we create from a scenario of economic development or growth for the small and medium scale industries or the just startups. What is your thoughts and what are the things that we can do to develop them?
Thank you. Good evening, ladies and gentlemen. Thank you for having me here, Raja, President, and APB. Although you say that I'm a veteran, I'm not a veteran in banking, but of course, veteran in other financial disciplines. But anyway, I have been with the banking industry for last 2 years. 2 years for me must have been about 25 years because such a tough time. So, veteran bankers are here like Mrs. Nanayakar, who is seated. And I remember Mr. Sivagananadan way back, I must have been at least a couple of decades ago. I met him when I was just probably must have been audit senior when I was doing my audits in the bank. Yeah, bank was still. He was. That's right. So then, 3 decades ago, I think he has produced 2 wonderful sons here. Those are here. Once again, thanks. Coming back to this, I think you need to understand. Let me take you through very, very interesting. The video clip I watched today. By the way, excellent presentation, Deshal. That's very good. I was a little nervous about looking at those figures and many things. But anyway, this is the reality. I think we all know about this. But now all will have to see how are we going to get out from this. I fully agree with my friend Sanat. Now policy consistency is absolutely important. I think we have made a lot of mistakes, errors in the past. But now this World Bank, I think they have put out a report. I believe that you all would have probably seen, or if you have not watched, there are 4 important areas. As bankers, I think we all need to seriously look at. But I'll come to your point later. One is about global recession they are talking about. I think there's going to be a massive recession, Deshal, especially in, it says that US dollars 157 billion loans have been granted, and they may not be able to collect this because of various factors. Especially the report focuses about China, because which is very, very important. And now coming back to SMEs, especially it says that 46% of the global SMEs are going to be fallen. and it's going to be out. And it talks about Asian countries, focusing especially our neighbor country, India. And it says about 65% of SMEs are going to be in trouble. So when you say SMEs are going to be in trouble, obviously, you know, you and I both will be in trouble. So that I think as veteran bankers, we all need to look at, because debt stress is going to continue. So that is number one. Number two is hidden NPLs, ladies and gentlemen. Although we say moratoriums, what do you mean by moratoriums? Those are, you know, we just keep on postponing these NPLs. So that is another one, because transparency in the private sector debts is an issue according to the report, which is again very scary thing. I think we all will have to understand. And management of distress loans is a key for us. How are we going to manage? And also they have kept alive these companies because of this moratoriums. Otherwise, I'm sure that, you know, you will, if you ask yourself, you know, what would have been happened to some of the companies they charge, it's going to be terrible. And other one is private debts and loans granted to SOEs becoming now, we have to become those sovereign debts now. So SOE, I believe that we don't have to go to any other country now. We can look at from our own country. So that's another issue that we all need to look at, because it says that this is happening in China mainly. This is happening in China at a very, very large scale. Another one is sovereign debts. Sovereign debts also, you know, borrowings by individual countries, I think, because he indicated those going to be in trouble, because then there's going to be some kind of default. Looking at your one, you know, about this management, yes, because I have seen from my own experience last 2 years interacting with large number of SMEs, because you need to totally have a major paradigm shift in your management, especially in SMEs, because there are quite a lot of opportunities that they have. But the issue here is, you know, whether SMEs will be able to handle those opportunities is a question for me, because of due to various reasons. So, but management style will have to be changed definitely, because now even online, we have never heard of Zoom meetings and all that, you know, prior to 2 years, but these Zoom things have been there right throughout. But have you ever heard of that? No. Now, if you want to connect any number of countries, within a second you get connected. So those, I think, will have to be monitored. But again, when you are working home, you become your own boss, because nobody is there to monitor you. So therefore, we need to have a foolproof system, rigorous process to monitor, you know, the performance. So that's, I think, management style will have to be changed. Likewise, there are various other things that we may have to look at. And psychological impact also matters, because now you don't meet personally, and that is a must. For me, of course, I may be old school of thought man, but I like to have personal, the human interaction, which is very important. Sometimes that helps us to have, you know, increase, you know, our productivity. This is how I believe. Of course, you may have your different views. So as when you are looking at your, you know, the own, you know, the opportunities or the way that you handle, I think, which is very important, especially now, mainly we may not belongs to that category, but we are dealing with not millennials, especially Gen Zs. So how are you going to manage Gen Zs? Especially your management styles will have to be completely changed. So that part you need to look at and see how we are going to look at. So I think, let me stop that. I think I'll take the next one.
Thank you, Mr. Rajabhaksa. Stemming from that, we spoke about moratoriums, but now recently the regulators issued new directions which are coming into effect from January on the classification, recognition, and measurement. And also this is linked to the new accounting standard treatment, IFRS 9. Now, in creating these in the upcoming financial years, it's going to be a really daunting task again to the financial or the banks. Sanath, could you share some thoughts now? What are we to do about that now? Different loan categories are there, different moratorium schemes are there, some are ended, some are to be ended in the near future. So everybody is expecting, as Ms. Rajabhaksa said, want to extensions or have waivers and interest. So now this is a daunting task for the banks in terms of how the financial structure would be presented. So could you share some thoughts on how this will be impacting us in the going forward?
Yeah. Actually, if you see when the pandemic hit globally, the business couldn't sustain without with the repayment, I would say. If they try to pay the debt, the banks and as well as the SMEs or business people would have collapsed. So one purpose of the moratorium is to sustain the businesses, especially in terms of working capital, so the business would survive to pay the future loans. But if you come to the IFRS, actually, it's a change in the way we look at provisioning, the traditional word provisioning. Yeah, going from rule-based to more expected loss model-based, more accurate kind of provisioning. So, and as Sujiva said, these profits are within the bank, although the interest had been collected during the moratorium. Banks have not specifically provided for these the entities which are now coming out of the moratorium from December, and tourism will come out of the moratoriums from June this year. So there are a lot of support we have to give to these, especially SMEs, for them to survive and contribute to the economy. Otherwise, the entire economy will collapse, and the banks will have some mortgage properties which are useless, like what we saw in US in 2008. So I think with the change, the IFRS or SLFRS change, which happened in January, first thing we have to focus on evaluating the credit proposal properly, especially the repayment ability and accurate forecasting of the cash flows. Because the moment earlier, the lending officers practically waited for 1 month for the installment to go into arrears, talk to the customers, then it goes to the second month. Some customers actually, as a practice, they delay for about 60 days and pay the installment, then the other 2 installments are in arrears. But now, if you see, if the cash flows are not forthcoming as expected, let's say 0 days past due, DPDs, the provision is like a general provision, let's say 0.75. The moment it touches the 31st, 32nd day, it can go to a flat 4%, provisioning, let's say, depending on the probability of default and LGDs in that particular product. So earlier it's 0, right? The general provision only 32nd day, 33rd day, they survive. Then 60 plus, you can go up to about 17, 18%. Hit to the bottom line, right? Then after 90 days, it can be about 40, 45%, depending on the credit loss model you are using. So this actually, one thing, it will give a more objective way of looking at the interest you collect to the bottom line in terms of comparing with the credit risk you carry. On the other hand, it will encourage the lending officers to be more objective in their evaluation without just forecasting things and depending on the collateral. Earlier, it was a haircut. Depending on the collateral, you can survive for even 2-3 years. It's not there now. So this will push the lending officers to proactively manage and also have some discipline in their portfolios. Then all the banks should have now, these models are not specified by the regulator. So there should be proper governance and, controlling frameworks around the, how you estimate this, how you calculate, then even things like economic factor adjustment is subjective. You have to collect data from central bank, maybe World Bank, then collect these things and come up with a factor which defines how much you have to provide. So there should be governance framework. Otherwise, different banks will start, reporting different figures. The auditors have a responsibility to see the integrity. Then the bank should invest in early warning systems. Now the credit officers can't wait for the things to go into areas to talk to the customer. The early warning system should, if you are having a robust early warning system, it should provide, even without a single days in areas, it will predict that in 3 months' time, this customer can be in the red list. So there's a proactive approach that pushes the banks to have quality and consistency in their portfolio. Then banks will have to invest in IFRS software to calculate those, because manually you can't do this. Then they may have to adjust their core banking platforms. But I would say this was coming, we saw this coming even before the pandemic. So this is a progressive move to, manage the portfolios in a better way and also reflect the bank's actual position. But what we discussed earlier was these moratoriums were ended maybe this last December. It's too early, as Sujiva said, it's too early for us to judge the portfolio qualities which are yet to come. So in that case, how the banks should reflect that in the provisioning. For that, there's a mechanism called, I think the bankers would know, you have to identify the high risk industries or risk elevated industries. And with the auditor's approval, we can go for management overlays. That is like additional provision. Looking at a certain sector, keep a provision in because you have collected that sector's interest into your account. So you create that resilience in the financials by having a buffer, and you are reflecting what is closer to the actual position of a bank. But that has created certain practical problems because in SMEs, if you see, okay, in corporate, you can say this customer is in construction industry, this customer is in, tea exports or whatever. But if you go outside and the SMEs, they have a hardware, they have a fuel station, they have some wholesale. So the moment one sector is risk elevated, the entire customer's portfolio is whacked at maybe 15% to the bottom line. Then the question is whether the manager will lend to these customers in the future. So those things, I think, we'll have to sit with the maybe accountants, the chartered institute, the auditors, and come into some practical way of handling. Otherwise, the moment the manager gives another loan today, first day it's factored the provision rate for the elevated industry. So those are the practical things we are discussing. But it is also a good move that we standardize our practices with the international rules rather than keeping a step back with the international rules.
Thank you, Isman. Mr. Rajapaksa, any comment on that area being in the accounting field and something on the standard setting of how it will also help the sector, different industries also by this standard that has come into play for the financial sector?
You see, being past president of the Institute of Chartered Accountants, I have to tell, when you have IFRS or Sri Lanka financial reporting standards, whether we like it or not, we got to follow those. I think that compliance is very important. I think it's better for, the APB or the associations will have to get the Institute of Chartered Accountants involved in, the discussion about these practical issues. I'm sure that, then they'll come out. But end of the day, by and large, it may not be possible because of the fact that we are also, Institute of Chartered Accountants also one of the full members of the IFAC. So as a result, it will be very hard sometimes.
Stemming from that, Mr. Rajapaksa, just one area now. International trade, it was daunting task with the forex issue. Now, recently, just yesterday, we see the dollar being floated. And initially, it had a cap of 230, and some last evening, it was allowed to free float. And the currency has now come up to a devalued value of about 260 as of closing today. Now, on international trade, now we have also certain limitations on importations, restrictions that have been come into play. But taking the bigger factors that require to be paid, which is the real task or the fuel crisis that is there, or the larger bills are for those. So now, will this situation of the floating of the currency, dollar, support that sort of payment mechanisms, or how it will reflect on the country's overall economy?
And we all know what will happen. I don't have to tell. But again, coming since you have posted this question to me, yes, we understand that one thing, People's Bank, Banco Ceylon, I think we are the two bankers who mainly support any government about essential, the imports, especially you take it petroleum or coal or even even, the pharmaceuticals, the gas or whatever you call, those bills are huge. Sometimes, about $30 million, $40 million in each, the import, which we have been somehow supporting. Even today, we had a couple of LCs. I'm a firm believer about, now floating the, but again, demand and supply now, yesterday, now today, I think we all are aware it was about 100, 250 and buying is 250, selling is 260. So in other words, but again, we also heard that Undial, now they have again shifted the goalpost. Now they are, I think, 290. So, but I don't know where we are heading, but one thing, it's very straightforward. They are nothing, it's not rocket science. Things are going to be very difficult because our imports are going to be definitely, very expensive.
Yes.
And as a result, as he mentioned, that your inflation is going to be huge. So those will have to be understood. It's very, very tough question, me being a chairman of a state-owned, the bank. But the fact remains that, this has to be done. Demand and supply. I'm sure that yesterday, even my own bank, I saw there's a tremendous increase in, the remittance. But today, I think, not day for yesterday. And today, yesterday it was little down. And everybody is vigilant, I think, because guys who are foreign, the people who are working abroad, they are waiting to see, what would be the best course of action that the government is going to do. But the fact remains, my gut feeling is, I think this will settle down. They shall, I don't know whether it's right to say that around 240, 245. Not immediately, probably, it might even go up to 300, but it will come down and settle, the maximum 250, let us say. But we all need to face the reality. There are nothing we could do at this moment.
Yeah.
So we are prepared to, but I know exposure is going to be huge. Country balance sheet, if you take the country balance sheet, I think the balance sheet will totally go for haywire, with this large amount of debts, if you look at. So this is the reality that we are going to face.
Mr. Rimmel, now, given the global economic outlook with the recent Ukrainian and Russian war that has caused global, it's another pandemic type of thing that has caused globally. Now, due to this, as a Sri Lanka, we are also dependent on certain imports which are critical from those countries. And also we have a large amount of our exports going on tea to these two countries. Now, given adverse situation, now the outlook for Sri Lanka is going to be much more detrimental again. Some thoughts on that? Anything how we will be facing in the next couple of months on this situation? Because the wheat flour also is one dependent that a lot of majority commodities of the low income depend on. And if you don't get that in time, then there is going to be another crisis on food.
No, absolutely. I think there's quite a few areas where there are impacts to Sri Lanka through the trade channel. I think the most significant, of course, is what's happening on oil prices. Right? So with Brent trading at above 130, I think it's a little bit yesterday and today. But last year it was averaging around $60 a barrel. So you're looking at effectively a doubling of the cost of oil, which is typically would amount for about 20% of our imports. So that immediately has a huge impact on our overall current account deficit. And at a time where we are having challenges with our reserves, that really makes it a lot more difficult. And yeah, it's not just crude oil. There's a number of food products. You quite rightly mentioned wheat flour. There's also a number of vegetable oils that are coming from that region. Tourism also, if you look at the last few months, about 25% of tourists have been coming from either Ukraine or Russia. I think the other problem is you might still have people coming, but a lot of them, they can't pay by credit card now because their transactions are being limited. So both from the inflow side, so on exports, you quite rightly said with regard to tea, we have a fair amount that goes to that part of the world. Again, really, it's the payment systems that are really going to cause a problem. So yeah, overall, it adds to a difficult situation that we have on the external sector, adds another layer of risk on the current account. So I fully agree with the point you made.
Also, with the fiscal and the monetary coordination, there seems to be some mismatch somewhere that has caused these relative problems. Now, in the way forward for Sri Lanka in this type of things, maybe the policymakers' decisions are not as equivalent to what is required to the current stand. So, going forward, is Sri Lanka going to be in a greater difficult task in the next 6 months, or whether people will find shortages? A lot of talk about food shortages and commodity shortages, and with that recent restrictions on imports, also there's going to be a lot of pandemic again with the people. Apart from the COVID, now they are going to face a different challenge. So how are they going to overcome these things in the general public? That's everybody is talking about what is the devaluation of the rupee, what it means to general public, because their commodity prices are going to get impacted.
So let me first touch on the point you made about the coordination of fiscal and monetary policies. So I think the changes we saw in the last few days have been in the right direction, right? So first of all, the increase of interest rates, the 100 basis point increase that we saw last week, that was a necessary response to what we are seeing with inflation, with the trade deficit and so on. So we needed to have an increase in the policy rates, and you have seen the market responding to that as well. And likewise, with the allowing the currency to move along with the market forces to depreciate, that also it does create pain. It does create increased costs of imports that will filter into overall price increases as well. But that was also necessary in terms of being able to attract inflows into the system. We saw the sharp decline that we saw in remittances. To a great extent, I think that can be addressed or improved with what's happening with the currency. So I think what is needed right now is you probably need to see a further increase in interest rates as well to control a little bit more on the demand side, to build in some confidence also, because right now, really, what as Mr. Rajapaksa said, there's still a bit of uncertainty as to if there is still a gap between the informal rate and the current market banking sector rate. You're still going to see people holding off on on converting. So really, there needs to be a sense that, look, there is a greater degree of stability in the overall macroeconomy, and once that confidence is instilled, overall we can see a little bit the system would probably settle. So further management of interest rates upwards, I think, is probably warranted in this situation, particularly considering where inflation is also. Now, in terms of the implications for the average citizen, I think we've already seen a lot of challenges in terms of access to particularly the significant imported commodities, right? So we saw that with products like milk powder, cooking gas, fuel in recent days. Again, a lot of that stems from the foreign exchange situation. So even though the depreciation of the rupee increases the cost, it should improve the availability. I think that's an important positive step. To some extent, I would think already some of the price increases might be captured into import prices over the last few months, because a lot of importers in dollars on the informal market. So there's a likelihood that some of that has already been captured. So hopefully we won't see a 30% increase in prices in line with the depreciation, but maybe a smaller increase to reflect that change at the margin. But either way, I think it's a shock to the system. It's certainly going to add to difficulties that consumers have faced. Small businesses reliant on imported components. That it certainly adds a further shock.
Right. Thank you, Mr. So since in management of time, we need to see, we could go one round of thought from Mr. Manathung. Any final thoughts on any updates that you feel free to comment on, any area that you can sum up?
Some practical examples I have gone through in other countries we operate. As Ms. Deshal said, the floating the rate is the natural, remedy for the problems we face. Maybe a bit late to come. If you see Maldives for last 5-6 years, they are having a controlled exchange rate, 15.31 to dollar. So we have seen there's a very fluctuating black market created there. When the dollar is available, it comes down to about 16 rupiah per dollar or 15 something. When the market is short of dollars during the pandemic, it went down to 20 rupiah. So the regulator has the regulated rate, but the black market shows the supply and demand. So once a permanent black market or a gray market is created, very difficult to get rid of that, because now we got remittance business. The people who got these people out of the banking system, it will take time for us to even at 260 to get them back, because we have created that window through trying to artificially interfere into the equilibrium of the market, supply and demand. So, and also there are some hidden costs also. Exporters convert their dollars, in the gray market, I would say. They sell it to the importers at, let's say, 240. Some exporters are giving that benefit to the buyer. Let's say you sell a kilo of tea for $5. Now they get 20% from the importer unofficially. So that is passed on to the buyer. So the country is losing 50 cents dollars for each kilo. So it's a permanent damage, and it destabilizes the export market also. There are so many ramifications, negative, things when somebody is trying to interfere into a supply and demand for a long time. So with that, I think, so we know the reality. Thank you.
Thank you, Ms. Banatunda. Mr. Rajapaksa, any final thoughts on how we can strengthen resilience and foster transition of this economy in future?
So yesterday, one customer came to see me, well-known, well-reputed, supposed to be a reputed customer. And I'm just telling you because you all also will face this situation. And he told me, Mr. Rajapaksa, would you like to become shareholder of my business? I said, why? Sorry, I may not be able to pay my debts, so then why not you buy some of my shares? No, it's a very serious issue. I'm telling you, it's a very serious issue. And after moratorium is over, then now they are getting ready. What am I going to do? Without offering their shares, because now here, there's a large amount of debt sitting in their balance sheets. What do? We need to be very serious about this. That is because we are sitting in VUCA world now. We are sitting in VUCA world because volatility, uncertainty, complexity, and ambiguity, all four are there. So it's prevalent here. So we as bankers, we need to be very vigilant about, especially looking at our risk factors. Whether we like it or not, ladies and gentlemen, we have to face for this. But again, we have to look at and see whether we are resilient. So how are we going to face for this? How are we going to face for this? World Bank reports, please read that report, then we'll understand that the future, what we are going to face is, I think, not that rosy, I must tell you. So with that, anyway, so whether we like it or not, we have to face it. We have to face it, that's the reality. So with that, let me conclude. I don't think that, that anything else that I can tell you.
Thank you, Mr. Mr. Dimel, before we just, the final sum up, just to talk, if you could sum up something on the per capita income. Now, our growth level expected was around to be about $4,300, but we had not met up to that standard in the given period. So anything in the foreseeable future, are we able to go up to that level, or will we go below that level further and further in the current scenarios of this economic crisis?
So I think in the immediate near term, we might see a further hit to that, because obviously there are two factors that really affect your per capita GDP in dollar terms. One is, of course, when you have a depreciation of the local currency, naturally your per capita in dollar terms is obviously going to get adversely affected. And also in terms of overall GDP growth, we've had in spite of the pandemic, we saw a good recovery in 2021 that was supported by fairly conducive monetary and fiscal policy. I mean, interest rates were low, taxation was low, and there was a good boost from both of those. But this year, we're likely to see both of those reversing. You're likely to see interest rates. They've already seen that interest rates increasing, tightening on both sides, which will, and of course on the exchange rate also. all of which will create headwinds for growth. So I think from both sides, in terms of the currency, in terms of fiscal and monetary tightening, you're likely to see a little bit more of a challenge situation in terms of GDP growth as well. So in the short term, we might have a little bit of adversity on per capita, but I think we all know that Sri Lanka has a huge potential going forward. We need to get our macro house in order and create some stability, and then that will create the environment to really take advantage of their growth in the future. But in the short term, there will be pain, but I think we can all be hopeful of good prospects in the long term once we're able to achieve a sense of stability in the macro.
Thank you very much, gentlemen, for your expertise, comments, and sharing some thoughts like today on navigating economic challenges at this 20th year remembrance of our veteran banker, Mr. Sivagananadan. And I hand over proceedings to Anjali to continue on the Sivagananathan Trust award recipients and invite Mr. Nathan to give a brief about the Sivagananathan Trust and what it has done. Thank you very much, gentlemen. We may move to your seats.
Sure. If there is any, yeah, we will take a few questions at because there are some award recipients who we could not have them physically present here today, but we need to announce their names of the. So and after that we'll take some audience questions. Okay, thank you.
Thank you so much, Mr. Sujiva Rajapaksa, Mr. Sanat Manatunga, and Mr. Deshal Dimel for sharing your thoughts and for that very informative and interesting discussion. So I think it's the contents discussed were very useful for all the participants here, the challenges we have to face, what we need to know, and what we need to do. So thank you once again, and thank you, Jeremy, for moderating the session. Let's move on to the next item. I would like to invite Mr. Nathan Sivagananathan from the Sivagananathan Trust to address the gathering.
Good evening, everybody. Thank you for being here. I know it's getting pretty late, so I'd keep my words to a few. First of all, thank you to Deshal, Sujiva, and Sanat for your insights into the banking world. We couldn't have chosen a better panel other than having a female in the panel, but having a economist, someone from the private banking and someone from the government side, public bank, it was a good balance to hear the difference. I can tell you that the VUCA world is actually something that is there for the banking world, whereas the private sector like us are going through a rupt world, which is about rapid, unpredictable, periodical, and tangled world that we live in. It's been a tough time for Sri Lanka. And my dad always used to say that tough times never last, but tough people do. And I think Sri Lankans are tough people, and things will change for the better very soon as we are focused. It's been 20 years, and I want to thank the APB especially and the IBSL for continuing to support the trust. We managed to support over 1,800 students over the 20 years and have also been able to work with the APB in awarding several students across the years as well. It's the first time we've had it outside the Bank of Ceylon, where he was well known for his banking world, and he would have loved a time like this because innovation is what is going to get you out of this current situation. And finally, just to thank Jeremy and Mr. Rajapaksa for their support from APB, and wishing Jeremy all the best for his new tenure as APB chairman, and thanking Mr. Rajapaksa for his support to the foundation as well. And to all the students out there, this is the best time to get into banking, and it's also a good time to get into the private sector. the private sector is also losing a lot of people to the overseas world as we speak. So thank you again.
Thank you, Mr. Nathan. So now I would like to read out the names of the scholarship receivers from the Sivagananathan Trust. Although they are not present here today, I'm sure most of them must have joined through our virtual platform. Right. Okay, so the annual Sivagananadan Trust and the IBSL awards, sorry. So the awards are for candidates who have excelled in the year 2021 IBSL DBF exams conducted by Institute of Bankers of Sri Lanka. So these are the award recipients. Miss W.R.K. Somatilaka, and then Mr. W.G.N.G. Wanka of Commercial Bank, and then Mrs. M.P.V.K. Vijay Singha from People's Bank, Mr. T.S. Patterson from HNB, Miss S.P.J. Ruan Mali from People's Bank again, Mr. S. Sivagananathan, and Mr. R.H.M.K. Sajiva from RDB, Ms. W.D. Sandamali from Central Bank, Mr. M.G.R.A. Jayaratna from RDB, Ms. R.A.T.M. Ranasinghe from Electro Solutions, Ms. M.R.I. Sashikala from Pan Asia Bank, Ms. P.G. Gruntusha from Sampad Bank, Ms. D.P. Varnakula Surya from HSBC, Mr. G.W.S. Asel from LCB Finance, Mr. T. Kopulan from Commercial Bank, Mr. T.R. Amir from NTB, Mr. D.M.C.S. Disanayaka from Commercial Bank, Mrs. T.R. Disanayaka again from People's Bank, Ms. S. Kidneswaran from Bank of Ceylon, and these are the double prize winners. Mr. A. Krishna Mevan from People's Bank, Mrs. G.C. Shiromala from Bank of Ceylon, Mr. S. Sivasensuran from People's Bank, Ms. E.M.W.S. Ekanayaka from Ceylon Bank. So congratulations to all the winners. Okay, so now we have come to the end of the session. I would like to invite Mr. Anton Arugumugam, the Secretary General of APB, to deliver the vote of thanks. You're going to take the question.
Jaja, it's a request for some questions to the panelists, so I think we'll just take a few in the interest of time. Mr. Sundar.
Thank you. Hi, good evening, everyone. So Deshan, really good presentation. I think my first recommendation is young leaders like yourself should be more in decision-making positions in the government. And I hope the government's paying attention to folks like yourselves. My name is Sundar Ramachandran. I'm the Managing Director of GSK in Sri Lanka and Maldives. We're not from the banking industry, we're from pharmaceuticals, which I think is a good signal to everybody here that tells you how interested we are in both your position and your point of view. I see, and I'm from India, been here for the last year or so. And my feedback to the banking community is I'm seeing a little bit of a difference in the walk and talk, right? So we're talking about the macros, which is understandable. We got to get that stability going. But a lot of that is beyond what you could do on a day-to-day operational basis. So I'd like to understand what is the banking community doing specifically to boost capital, okay? And when I say capital, I'd like to see what specific advocacy, education, funding you're putting in to boost human capital. So, we've got a burgeoning education sector here. We've got Nathan was saying, we got talent leaving the country, and as business leaders, we're struggling to find good people. So what are we doing to keep people here? Number one. Number two, what is it that we're doing to create an active, capital market environment within, right? What's the participation of the retail investor? I think it's very poor, right? What lessons can we learn from countries like India, which have done systemic work to improve that? So I think those are some clear actions I'd like to see from the banking community. Because sometimes I feel, being on the other side, being a client and customer, I feel like talking too much about macros is like a software of procrastination. So that's a watch out from the industry I'd like to provide to all our friends and colleagues in banking. And we'd like to see more clear, concrete action on the ground. So if there are examples, I'd love to be educated on those. But if not, I'd like to humbly submit that as my feedback to the community. Thank you very much.
Thank you, Sundaram. Any of the panelists would like to answer that on human capital and Sanat?
Thank you for the question. One thing is talent management had been a key strategy in all the banks internally, because we have seen the digital penetration, for example, is happening fast, and it accelerated during the pandemic. So future of banking, if you want to transform, it should be more not a organic change, but it is a leapfrog transformation, which couldn't be driven without a talent transformation. That's what we believe, and across the banks, it's happening. So if you see the investment digital and investment in non-co related training and skill development is happening, then knowledge transfer is happening between banks and also between countries. For example, we have our agency bankers and also partners like Visa, MasterCard, who create the skill levels towards the futuristic developments. On the other hand, now, for example, DBS, if you see out of 25,000 employees, now around 10,000 are IT skilled. Not that they have employed, but sometimes reskilled, or they started, recruiting IT talent into the bank, because banking has become non-traditional to a large extent now. So that I think most of the banks for the last 5 years is in that drive. If you see the banking sector, digital penetration would have been, 50-60% the uptake from customers' point of view. And also it's like we are investing, even educating the customers in these technologies and push them towards these apps and, futuristic things. And also in terms of sustainability, we are educating our customers. Now, parallel to the digital, another pillar the banks or any responsible corporate should develop is sustainability. So in the sustainability front, without that being a business priority, we as bankers, we have committed for, social and environmental management framework of IFC, let's say. So we educate our customers, and also we try to be responsible lenders rather than just lending to any industry across the board. So that is also, I would say, it's a learning for the culture, and also progressing the communities, the country towards futuristic, internationally comparable goals. On the other hand, from a micro level, now all the banks are having education loans, and we have partnerships with certain universities and IT companies. While educating, we give loans. Or for example, Indian company HCL, we have a partnership. Thousands of students who employed by HCL, we have a partnership. And also in IT universities, we fund them with favorable terms. And also all the banks, I think now, fund for women education, women empowerment. So those things are happening actually. But the brain drain is not because there are less opportunities, but it's happening because of the instabilities they see in the country. And the parents also, they encourage them to, go to better prospects. Not that the banking sector or any other sector is not, doing their part to retain them, but obviously the young generation now, for example, IT, we are losing a lot of IT people in the banking industry, and some are given opportunities to join foreign companies but work from home. right? We can't afford to do that. And also certain software engineers employed working for a US company from Dubai or Sri Lanka and given the money in dollars. So retention has many aspects. So I think as a sector, we had been doing our part. And also all the banks are having CSR and the UN global this thing, the 2030 goals, at least 4-5 are in the CSR and also the investments in the banking. So those are also, education. In commercial bank, education is the number one. The sustainability goal we actually invest in. So we have already created about 100 IT labs across the country. Like that, I think all the banks are having those sustainability goals also in their agenda. Thanks.
Can I also comment from my side? Yes, sure. Thank you. See, People's Bank has been providing, the financial facilities for especially university students. Last year, we started another, the important scheme providing 15,000 laptops to, the entire university system. This is one of them. And likewise, there are a large amount of portfolios in our bank providing facilities for universities and schools and, the so on and so forth. Looking at from our own talent, the retention and things like that, we do have well-structured programs, especially focusing soft skills, which is sometimes comparatively lacking, whereas our people are very much strong in hard skills, but soft skills sometimes, but of course, India, I have been so many times to India and Indian, especially Chartered Accountant Institute, we understand about your capacities, capabilities, but I am sure, we are also equally competent. But brain drain is a huge issue, but we always preach our people why they should, the retain here in Sri Lanka. So that part is happening, but still because of the circumstances as such, it's difficult for, the short term, there is going to be an impact, but long term, I'm sure, they'll come back. Thank you.
Any more questions from the audience? Okay, I would like to invite Mr. Anton Agamugam for the vote of thanks now.
Keynote speaker today, Mr. Deshal Dimel, Senior Independent Director, Sampath Bank, panelist, Mr. Sujiva Rajapaksa, Chairman, People's Bank, and Mr. Sanath Manatunga, Chief Operating Officer of Commercial Bank. Mr. Arul Sivagananadan, Mr. Pranavan Sivagananadan, Mrs. Sivagananadan, and the family members of Mr. Sivagananadan. Board of Trustees of the Sivagananathan Trust, President of APB, Council, and the Council of Advisors. Award winners, families, and distinguished invitees. Ladies and gentlemen, a very good evening to all. It gives me an immense pleasure to deliver vote of thanks to all dignitaries assembled here at this annual event of in the APB calendar. This is a laudable endeavor from both APB and the K. Sivagananathan Memorial Trust Fund to reward and recognize the high achievers in the sphere of banking education in the country. The late K. Sivagananathan, an innovative banker, Sri Lanka, and one of the APB founder member and past president, he had contributed most to uplift, upgrade, and to grow unprecedented heights through many innovations in Sri Lanka Premier State Bank. His tireless contribution to improve the standard of education in banking and finance in Sri Lanka to international standards, together with the APB and IBSL. I wish to thank Mr. Deshal Dimel, Mr. Sujiva Rajapaksa, and Mr. Sanath Manatunga for the insightful and informative information that has been provided under the topic of navigating Sri Lanka economic challenges. Discussed points here today, I'm certain to a great extent the encouragement to all young bankers here. Thanks all go out to the family of late Mrs. Sivagananadan, Chairman Mr. Nathan Sivagananadan, and directors of the trust for their cooperation and assistance in making this event a success. I also wish to thank President APB and the Council of Advisors for their support, and especially the co-chair of Continuous Professional Committee, Anjali Gunatilaka, for successfully organizing this event. Let me also congratulate all the winners today and our appreciation to you for your efforts and the very best to you in your careers. Without you, this event could not have been taken place in this successful manner. I would also like to thank IBSL for all the arrangements made and lending us this auditorium. Thanks also go out to the award winners for virtually joining us with us today. So with this, I conclude my vote of thanks. Thank you.